This video is all about state taxes. So we're going to cover everything you need to know about state taxes and how they affect you. So there's three primary ways that you are taxed by the state that you live in. The first is the flat income tax. The second is the progressive income tax. And the third is the state sales tax. So every state has some combination of either one, two, or three of these things. And we're going to go over all of them and which states have which and all that. So a flat income tax is when everyone in the state is taxed at the exact same rate regardless of their income level. So again, whether you make $1 or $100 million, you're taxed at the exact same rate. That's why it's called a flat tax. So let's check out all the states in the US that have a flat income tax. And so you can see New Hampshire there is the lowest with a flat income tax of 2%. And then Idaho is the biggest. And this is all as of 2025, and these things are always changing. So whatever it is in 2025, in the future, they will all be slightly different. So let's go over the second type of state income tax, and that's the progressive income tax. And unlike the flat tax, states with a progressive income tax have tax increases at incremental income levels similar to the federal income tax. So that's all just a fancy way of saying tax brackets. And so this is all like how the federal income tax is based, but every state has different brackets and different levels. So this is just an example. This is not an actual state's brackets, but it's the idea that you'd be taxed at different levels. The money would be chunked from 2% to 4%, 6 to 8, all the way up to 10 in this scenario. And again, every state that has a progressive tax has different income and rate brackets. So since we live in Oregon, let's go ahead and check out Oregon's tax brackets. So Oregon has a progressive tax with 4 brackets, and we're going to look at what this would look like if you're single or married filing separately. So the first $4,300, you're taxed at 4.75%. Then the next $6,450, you're taxed at 6.75%, 8.75% for the next $114,250, and then all that adds up to 125. So if any dollar after 125,000 is taxed at the highest rate of 9.9%. So let's actually do some math on this. And let's say you made $200,000 of taxable income in Oregon. How would this break down with these tax brackets? So the first one, again, 4,300 at 4.75% rate means you're taxed roughly $204, but you still have 195,700 that needs to be taxed. So now you have 6,450 of that taxed at 6.75%, which is $435. Then we have a big chunk, 114,250 of this is going to be taxed at 8.75%. And then if we subtract all that, that's 125,000's worth that we've been taxed through 3 brackets. So we still have $75,000 left that's going to be taxed at 9.9%. And so that's going to be that number right there. And so to find out how much total tax we paid between all 4 brackets, all we got to do is add them up. And so that's going to add up to $18,061. So to find the effective tax rate, we're just going to divide that by 200,000, and that's going to give us 0.09, or roughly a 9% overall tax rate. So now let's compare that to if we paid just a flat tax on the same amount of taxable income. So let's say you lived in North Carolina. What does that look like if you are single or married filing separately? How much are we going to pay in that flat tax? So remember, flat tax, anything from $1 to theoretical infinity dollars, is going to be taxed at that same rate of 4.5%. So that makes the calculation easy. We're just going to go 200,000 times 0.045, and that's going to give us $9,000 we've been taxed off that flat tax. So let's compare Oregon to North Carolina on the same amount of taxable income. So Oregon, you pay a little over $18,000 at a roughly 9% rate, versus North Carolina, $9,000 on a 4.5% rate. But we will come back to this in the end because this is actually not the full picture of how much taxes you'll pay in both of these scenarios. So that's just 2 states. Now let's look at a map at the whole US, and this map shows the top individual tax rates, meaning the highest bracket you can be taxed at, not the average rate. So this map is from a good resource called the Tax Foundation. It's one of the best sources for tax info you can find on the internet, and you can find everything you need there at taxfoundation.org. So when we look at this map, it looks like the highest brackets you can be taxed at are here on the West Coast, over here in the Midwest, and then the Northeast. So the rest, it doesn't have quite the highest progressive income tax brackets as those areas right there. So that is the first way that you are taxed by the state, is either by the flat income tax or the progressive income tax. But that is not the only way the state can tax you. Another way is by the sales tax. This is another huge way states collect revenue, and that is pretty much a tax on stuff that you buy. So there actually are only 5 states with no sales tax, and Oregon is one of them. So although it's a high income taxes here, there is no sales tax. And so the other ones are Alaska, Delaware, Montana, and New Hampshire. So in these states, the prices on the menu will be the actual price you pay, versus everywhere else you're going to have that extra charge at the end. So now when we have sales tax in mind, let's go back and look at this Oregon versus North Carolina scenario, because North Carolina also includes a 4.75% sales tax rate on top of the income tax rate. So that means you're going to actually have to pay 4.75% on every purchase or most purchases you make in North Carolina. So on what state you end up paying more tax, and it really depends on if you save a lot or spend a lot. So North Carolina would be a better place for taxes if you save a lot of money. So if you're not spending a lot, North Carolina is better. But if you spend a lot, then Oregon is better because you're going to be taxed at 0% on all your purchases there. And let's take a look here. Let's actually crown the great state of Alaska here. We're going to crown Alaska because Alaska is the only state in the country with no sales or income tax. So if you want to avoid any state taxes, move to Alaska. Let's go over the state sales tax a little bit more. And again, that's just tax on stuff you buy. Just some quick numbers here. So the average state sales tax nationwide, depending on the state, is about 5 to 6%. However, most states with sales tax, the local counties will usually add in their own sales taxes ranging from around 2 to 3%. So the actual total state sales tax when you add state plus county in most places is going to range from around 7 to 9% added on to your total purchase price. Okay, now we're done. Actually, not quite. There's still another thing we got to go over, which is capital gains tax. Because capital gains tax works a little different at the state level because, again, you got to pay the federal capital gains tax, but you also got to think about the state capital gains tax as well. And the way to think about it is that most states treat capital gains as extra income. So if we look at an example, if you made $100,000 plus $20,000 of capital gains, the state would recognize $120,000 of income because you got the normal income plus the capital gains that you made. But remember, this is not what you would be taxed at. You first have to factor in the deductions, which would then be your taxable income. So one last question is, how do state deductions work? So when we're talking tax write-offs, how do those differ at the federal and state level? So at the federal level, you have the option of the standard deduction or itemized deductions. And at the state level, it's the exact same. You can choose the standard deduction or itemized deductions. So let's say you're filing as single and you tallied up $10,000 of itemized deductions for the year. So for itemized deductions, you have the option of $10,000 for federal or state. So if you remember, the standard deduction for the federal income tax this past year was $15,750. For state, it's different for every state. But again, let's use the example of Oregon. So in Oregon, this past year, the state standard deduction was $2,800. So a key is you don't have to pick the same option for federal or state. You can actually just pick whichever one is better. So for the federal, we would take the standard deduction because it's more than our itemized. However, at the state level, the standard deduction is a lot less than our itemized, so we would go ahead and use itemized deductions for the state, this is why it's very important to keep track of itemized deductions, because the standard deduction at the state level is much less than the federal standard deduction. So it's hard to have more itemized deductions than the federal standard deduction for a single person is $15,750. But it's not that hard to find more than the state standard deduction in itemized deductions. So that's why you should always keep track of those because you can usually use them for state taxes. I threw a lot at you there, but now we are actually done. And just one last reminder to take it easy. Take it easy.